Started with understanding financial markets with price charts. So it's no secret that online trading can be performed more efficiently if you possess the necessary tools. And a good place to start is with charts. Whether you're using fundamental technical or quantitative analysis, there are a number of methods used by forex traders to predict the movement of currency pairs and other assets you can trade in CFDs. Some traders focus on news, interest rates, and economic variables, while others prefer to use charting tools and indicators to guide their trading decisions. However, no matter your trading method, you'll need to know how to read a financial chart. There's no escaping it. Luckily, we've created tonight's class to help you get started. Now, you must crawl before you can walk. And with financial charting is no different. You need to first have a good understanding of the basics before you can progress on to the more advanced stuff. Now, a price chart is simply a graphical depiction of the current and the historical price of an asset. And the prices on charts don't vary from chart to chart, person to person. These are fixed prices in the universe. Now, charts typically have several different modes for displaying price. One method that price is shown can be called or is known as Japanese candlesticks. Candlestick charts are the most commonly used method for indicating the price on a chart. Now, candlesticks have been around for a very, very long time, but they did not grow in popularity until the recent online investing market grew, and these new HTML charts and Java charts have allowed us to use candlesticks in a fairly easy fashion. So price can be displayed on a chart as a line. Okay, this is the most fundamental basic chart. Line charts are a good way to simplify the display of price. A line chart will show you the closing price of each period. Another way to display price is using a bar chart. A bar chart is similar to a candlestick chart. A bar chart will show you where the price opened, the high, the low, and the close. But remember, no matter what type of chart you're using, it's simply a visual depiction of the actual price movement. So a line chart is the most simple of these, and will only give us a very general view of a price movement because we don't see the opens, the highs, and the lows. We only see the close. And we simply put a dot on the chart for each period and connect these dots together. The next is a bar chart, which is my favorite type of chart. A bar chart gives us a lot of elements in a very easy to visualize format. We see the open, the high, the low, and the close for the time period in which we're looking at in an easy displayed fashion. And by seeing these four pieces of information, we get to see a lot of commonality. We get to start interpreting price movement. So each one of those bars that we saw on the chart represents the high and the low, the open and the close for that time period. So if we're looking at a 15-minute chart, every 15 minutes, we're putting one of these bars on the chart to cover the price action for that 15 minutes. If we're looking at a 1 hour chart, we're putting a bar every 1 hour. If we're looking at a 1 day chart, we're encompassing the entire 24-hour period in that bar. And if we're looking at a 1 hour chart, we're putting the highest that price reached in the 1 hour, the lowest it reached. We're putting a line across at the open of that 1 hour and a line across at the close of that 1 hour. Now, if we step up the ladder from the open to the close in that time frame, we've said to have a bullish time period. If we step down the ladder in that time period, we're said to have a bearish time frame. So that tells us who's controlling the market in that period. as well as helping us see how price moved. Candlesticks and bar charts are relatively the same. They encompass the same 4 data points. So although bar charts and line charts are quite popular among Western traders, Japanese candlestick charts and additional patterns were introduced to the Western markets in the 1990s. The popularity of candlestick charts has soared over the last few decades because of its highly accurate predictive features. Candlestick charts can play a crucial role in better understanding price action. Now, a candlestick is placed on a chart on the same time frame, just like we looked at the bar chart. Okay, and we put a dot for the high, a dot for the low, a line across at the open, and a line across at the close. We connect the open and the close together to form a body of a candle. And this area here is called the body of the candle. These lines between the body and the high and the low are called the wicks or the shadows. Again, if we stepped up from the open to the close, we have a bullish time frame. If we step down from the open to the close, we have a bearish time frame. In candlesticks, we color in the body depending on whether the candle is bearish or bullish. If it's a bearish time period, we would color it in with red. And if it's a bullish time period, we would color it in with green or white and black. So in essence, it's the same as a bar chart, except this is where we run into the fallacy with candlesticks. Because candlesticks are based on the body and the shape of the candle, its preceding candle and its next candle, and the representation of price movement in those candles. As we can see on this chart, some candles have very long bodies. Some candles are flat and have no bodies. Some candlesticks have long upper wicks. Other candlesticks have no lower wicks. Each of these candlesticks tells us something. And there are 32 different types of candlestick patterns. And in order to use candlesticks properly, we have to understand what each of those candles are. But because we're human beings and we see lots of reds and greens, we presume or assume the chart is trying to tell us something. When reds and greens don't have much to do with the candlesticks, it has to do with the shape and the size and the position. So although the same 4 values are found in the Western style bar charts, the bar chart uses horizontal lines on the side of a vertical line to project the open and closing prices, but a series of candlesticks on a chart can help traders identify the character of price action more definitively, which helps in the process of decision making. So let's go take a look at some live charts. So here we have a candlestick chart. We're looking at a 1 hour time frame, and we'll talk about time frames in a second. But we can see lots of reds and greens, and we can start making some trading decisions. But today's charts allow us to do some things that are very modern. Because years ago, when we would chart by hand, you couldn't just click on a button and move from a bar chart to a candlestick chart. So here we have a bar chart for the same exact time frame, the same exact everything. And price doesn't alter. Price doesn't change. Price is price. So therefore, all we've changed is the candlestick shapes for the bars. Now, when we take away the reds and the greens and these bodies, we can more clearly see some price action. And as you can see here, we have a trend line in here. It was much easier to draw this trend line without the congestion or the confusion of these candlesticks. But we can also convert it very quickly to a line chart. As you can see, this line chart tells us very little and didn't help us draw this trend line on here. Because look at that, price never touched this trend line because we're not seeing the highs and the lows. But you can use whichever method you would like. You just have to learn to use them effectively. So one of the best reasons to learn how to read a chart correctly is so that you can apply technical analysis. Now, what most traders don't understand is anything and everything that we do on a chart is part of the school or the science or the art called technical analysis. Many traders mix up the term technical analysis with technical indicators. And they get so involved with these indicators like MACD, RSI, stochastics, that they fail to understand that this is just one specific field of technical analysis. Anything we do on a chart, from looking at a line chart to putting candlesticks on the chart, is part of technical analysis. Now, not every trader believes in using technical analysis, but it can be useful. Even if it's not your primary trading method, technical analysis relies on price that is on the chart you are using. Most charting systems allow you to add technical analysis tools as overlays on your chart. Now, always check the time frame displayed. Many trading systems use multiple time frames to determine the entry of a trade. For example, a system may use a 4-hour and a 30-minute chart to determine the overall trend of a currency pair. Now, we have many different time frames. We have short-term time frames, long-term time frames, intermediate-term time frames. Okay. Most traders use a time frame that fits their trading style. Most of us in class today are short-term traders. In other words, we don't intend to open a trade that's going to last, say, more than 24 to 36 or 48 hours. In fact, most of us have our trades lasting less than a few hours. So therefore, we'd want to use a shorter term time frame to enter and exit the market. But we would want to use a longer term time frame to determine our trading, whether we want to buy or we want to sell. So to ensure, okay, so let's go back to the charts. So in other words, right now we're looking at the euro US dollar in a 1-hour time frame. But we can pick whatever time frame we want. Price doesn't change, but if we go from a 1-hour chart to a 30-minute chart, what it's done is taken that 1-hour candlestick and broke it into two, the first half hour and the second half hour. So now we get to see price movement more defined. So in other words, if we were looking at gold, actually, let me pop up gold here on the chart. And if we were looking at gold, on our chart, and we're looking at a 30-minute time frame. So gold right now is trading at about $12.99. Now, say for instance, gold in this 30 minutes ranged from $12.99 to $13.25, but gold in the last half hour was at $12.50 and moved up to $12.99, and now is trading at $12.99, $13.25. We wouldn't have known when we looked at the 1-hour chart that gold had stepped up the first half hour, made a big move up, and then made a smaller move up in the second half hour. We would have just seen that 1 hour gold had moved from 1250 to 1325. So by using shorter term time frames, we can see more definition of the price movement. But we would still not want to enter a trade. Gold's a horrible thing to look at tonight. Let's try oil. See, maybe we get some. Okay, so we're looking at oil on a 1 hour chart. Okay, and as we can see, oil's been steadily trading upward. Okay, 1 hour in this one last hour, we have virtually no candlestick. It's moved nothing at all. So in the hour before, look at that. We see this low and this high with this little drop in the body. And if we were to combine that, break it down to a half hour time frame, okay, we can see a lot more. We can see the big move downward was in the last 30 minutes earlier. In this 30 minutes, it's made no move at all. Where if we were looking at 1 hour, we couldn't tell that it moved 30 minutes ago. All we see is in the last hour, we see this little bar in here. It hasn't moved at all. Okay. So we want to go back to a 1 day chart to make our trading decision. Do we want to trade oil to go up or down? And then we want to then look at a shorter term time frame to identify the price level we would want to enter a trade, hypothetically. But a chart will help us do that. Okay. No matter what type of fundamental analysis you're using, no matter what was in the headlines, if OPEC said they're going to stop production, if the North Korea summit with Trump upset China and China said they're going to stop importing U.S. crude oil could have soared. This is fundamental analysis. Okay? Crude oil soars. Still, nothing there would help us decide when to enter the market, where to put our stop loss, and where we would want to potentially exit the market. We're only going to get this off of a chart. So understanding how to read charts is very, very, very important, because no matter how you're trading, you have to look at a chart to decide where to enter and exit a market. So the first thing we want to ensure is when we're looking at a chart that we have the correct time frame. And the best way to do this is set up charts with the correct time frame and indicators for the trading system and save this layout. So all charts will allow us to set them up and save our trading systems and our layouts. Okay. Now, the first thing we want to do is we want to go to our charts and make sure we have the right time zone set on our chart. So I use universal time for all of my charts. It matches up with my economics calendar. It matches up with my trading platform. But you want to make sure you have your time zone set correctly. Okay. You can also set up the colors and the background and the grids and the color of our candles, how we want our borders on our candles, what price lines we want, and set them up and save our template. So as you can see, we call this Barry's bar chart class, and I save it for my class, and I always know where I'm at, because on our charts down below tell us the time frames we're looking at. You don't want to confuse these with your local time frame. You don't want to have them misaligned with economic zone. Okay, you want to have these set so they're properly set regardless of the time frame you're using. You want to set up your chart to fit the time zone you're using, so that it's always, so you don't make a mistake in interpreting price. Once we have that, we want to decide what time frames we want to use for our charts, the type of charts we want to use, what colors we want to use, and all of this so that we have something standardized for our trading decisions. So realize that the times shown on the bottom of the charts are set to a particular time zone, that your provider's charts are set to be in GMT time or whatever time zone you want them to be. Make sure you set the chart time zones for your charts. Also select a time frame for your charts. One of the most important steps in using currency charts or any other financial chart is to set specific time frames. The value you view are only relevant to you for the specific time frames that you establish for them. Charts help traders evaluate market behavior and help them determine where the security will be in the future. To help make sense of the price movements depicted on charts, traders have developed a number of different visual guides to assist them, known as indicators. Now, there are hundreds of different types of trading indicators developed to cover every aspect of trading, from trend following to means reversion. Once you've decided what chart works best for you, what time frame or frames you want to use, then it's time to start adding some basic information to your charts. Any analysis done on your chart is called technical analysis. Now, I believe regardless of how you want to trade, what information you want to use, and how much you want to learn, regardless of your strategy, you need to put some basic lines on your chart to help you understand the markets. One of the first things you need to do is be able to place a trend line on your charts. Now, we have full classes, full 1 hour classes on learning how to set up a trend line and how to add a trend line and the rules of trend lines. But every trader should be able to add some basic building blocks. And these are trend lines, support and resistance levels, and volume. The more information you add to your charts, the more likely you're going to arrive successfully. So let's go back to my chart setups. Okay, so here we can see a simple trading chart for Bitcoin. Okay. Here we've established a long-term trend and a trend channel, okay, to help us make a determination of where we expect Bitcoin's price to be in the future. Here we see a Australian US dollar with a trend line on there, and here we've identified a chart pattern called a head and shoulders, left shoulder, head, right shoulder. Once you understand how to set up your chart, you can start looking for these patterns. You can start adding trend lines, start adding support and resistance levels to start making or start interpreting price action on your charts. We can see support and resistance levels, and we can build support and resistance zones to start predicting where price should go and how price should act and react at certain levels. So learning how to properly use charts to help predict financial markets is very, very important. So once you've learned and established what type of chart you want to use, what type of time frame, you got them set up, what colors you want to use, and everything else, we can then start building on that chart and add on the basic fundamentals, which include trend lines, support and resistance levels, and volume. Volume helps us see how many traders are entering and exiting the market, what volume, how many contracts are being executed, or how many shares are being traded. Because when we see price move and act or react to these levels, we can see if the other traders or traders around the globe are supporting these price levels or these patterns we've seen. But before we can do any of that, we need to be able to understand and read a chart. And once you do that, you can start seeing how price reacted to economic results, how price reacted to news. You can actually start telling an entire story of the day by simply looking at price movement on these charts. But you can't get started without mastering those. So we offer a whole range of classes. We have a whole 1 hour class in trend lines. We have a 1 hour class in support and resistance and volume. Then after that, we can start adding our technical indicators onto our charts. And our technical indicators are placed underneath our price action on the charts. So here, if we want to start evaluating oil, we can add on indicators like MACD by simply dropping those moving average convergence and divergence. There we go. By adding that on here, we can add on Bollinger Bands and some of the most popular indicators and oscillators. We can start interpreting price movement and understanding what markets are doing. But before we can do any of that, we have to learn how to read our charts. We have to get accustomed to looking at charts and finding commonality in price movement. So look at this. We can start looking at specific price levels in the past and the present and seeing how assets reacted So look at that. We see how oil held to the 65, see the gold level. Look at that. We see the highs, the lows all reacting. Look at all the highs we saw moving back all the way to the last week. We can see how that price has been so intricately important. So as we can see prices trading up here, as it dips back down, we would expect some type of reaction at that 66.03 level. We can also isolate another point. This gives us our support and resistance, or our ceiling and floor above the current level. By looking at bar charts, we can simply see the opens and the closes that prices were important or have in the past had significant value. And we start isolating important understandings of this price. When we simply add on volume, now we can see the amount of buys and sells as prices moving along to see if traders are supporting a price movement. And we have some basic foundations or building blocks to understand what price action is trying to tell us before we build any type of trading strategy. We haven't made a trading decision. We're not deciding whether to enter and exit the market. We're not talking about making a trade. Here we're just talking about analyzing price action, building trend lines, building support and resistance levels. I mean, if we want to add a trend line on the oil price, there's our longer term. And there's our shorter term. And we can start interpreting how we expect an asset to move. So the very beginnings of everything is based on reading a chart. It's like learning to walk. Once you learn to walk, then you can learn to run, then you can learn to ride a bicycle, a scooter, and everything else from that point forward. But we have to start somewhere. And so learning to read a chart and learning the type of chart you want. You might prefer a candlestick chart. Well, then fine, learn the patterns of candlestick. And we offer 2 one-hour classes in candlestick charts. Okay, we'll help you learn this, but first you have to understand to look at a chart and understand what it's trying to tell you about price action. Then you start adding more and more indicators and oscillators. You start looking for price patterns. You can start interpreting the candles and what they're trying to tell you, or the bars and what they're trying to tell you. But first, again, you have to get used to looking at price on charts. So on that note, I'm going to say goodnight to everybody. Thank you very much for joining us. And again, go to www.alvexo.com, set up a demo account, use their advanced charts, and watch their videos and classes on how to use charts and interpret price. And then join us for our class on beginning technical analysis. So have a good night now. Again, thank you for supporting us, and thank you for joining us tonight for our class.